without those layered financings, Jade, without the different types of programs that we've worked with many of the partners that are sponsors here today, working together to bring this stuff in and bring this homeownership dream alive, is that without all of those layered financing, without those types of portfolio programs, those families, the vast majority, 9 out of 10, would not have been homeowners today if it had not been for that type of financing structures.
It's funny, we grew up and we often heard the saying, it takes a village, right? And we just thought it was to raise a child, but it seems like it takes a village to own a home as well.
It really does. It really does. I think, there's a lot of types of programs out there, your conventionals, your Fannie Mae, your FHA. Those are all great products. But when you bring different things that are not out there, not regularly known, it is a village. It is your Joseph Gutierrez's, our board chair with Union Bank. It's Sal Mendoza from City National. It's Secretary Lourdes Castro Ramirez. Berta Garcia, co-founder with Rodney Fernandez. I worked under Mr. Rodney Fernandez, the late Rodney Fernandez, just like Lourdes did, and he had an impact in my life as well. So here we are. Here's somebody now that's been able to take this on a national level, and just being able to be around those kinds of folks, the wealth of knowledge has just been extraordinary, and I'm lucky to have that.
Absolutely. All right, well, let's jump into our questions. Alex, what credit qualifications do you need for down payment assistance?
So you don't need down payment assistance programs are not credit driven. So you don't need a credit score per se. As long as you can qualify, or the buyer is able to qualify for a first mortgage product, whether that's an FHA, a conventional, a portfolio product, and you are eligible for the down payment assistance, the different criteria that requires you or somebody to be able to take advantage of down payment assistance. Certain things are like first-time home buyer, you're under an income limit for a household size, then you're able to take advantage of the down payment assistance program. So FICO score is not a factor, usually.
Okay, you brought up income. Are there income levels that are needed?
There is absolutely. So some programs, we in the presentation that we did that was just done here a little bit ago, we talked about what income limits. What's a low income borrower? What is a moderate income borrower? And a lot of these are really important factors because they're published by the federal government, usually through HUD, and there's others that are published through HCD, the Housing Community Development, through the state of California. And every state has a different published criteria. So in Ventura County, for example, who is a low-income family? If you're a household size of 4 and you're earning under $90,350 a year or less, you're considered low-income in Ventura County. Isn't that amazing?
That is insane.
$90,350. If you're earning $90,000 in Ventura County, you are considered low-income. You are under 80% of the area median income, and thus eligible for a lot of these down payment assistance programs that are out there today. The other one, for example, in Santa Barbara County, that amount is $95,300 or less for a household size of 4. So, we want to see where that household size is, because one of the questions is, well, what if I'm a single person trying to buy my first home, or a household size of 2, single mother and daughter, the story that we heard from Karen. In Ventura County, that same number is $72,300. So a single mom, one income at $72,300 or less is considered low income. So that's a pretty high amount, it's a pretty high amount. And we would look at it for every county. Los Angeles County is, for a household size of 4, is $90,100. We've expanded to Kern County right now. The need out there is also great. And we've gotten a lot of our programs approved in Kern County. So in Kern County, a household size of 4 that is considered low income, that's $55,900 or less. So we look at those incomes, we look at the family size, that really matters. The larger the family size, the more you can earn and still be under that low income criteria.
Which leads us to our next question from Kelly Jones, who asked, is there too high of an income to qualify?
There is, once you get to a certain amount, but that's an excellent question, because when we look at qualification, at VCCDC and most anybody else that's doing any type of down payment assistance, we're looking at everything in one meeting with clients. Is what are you eligible for and what do you qualify for, right? So it has to be that perfect bullseye. So if somebody's over that amount for a household size of 4, then we look at something that the secretary mentioned in her discussion today in her keynote address, the Hfa Program through the state of California. In the state of California, There's monies available for down payment and for closing cost assistance. Now, if somebody is earning over $194,000 a year in Ventura County, then you're not eligible for those monies, right? But if you're earning $194,000 or less, you would be eligible potentially for those down payment assistance programs. That is an enormous portion of the population at that point.
Alex, those numbers are staggering. Like that is
Huge.
just, wow. Okay. Well,
Yeah.
I mean, I'm shocked.
Right. Right. So to go back to, was it Kelly's question? I think Kelly.
Yes, Kelly.
Going back to Kelly's question, if she's earning over 194,000, she's probably doing pretty darn good and may not need our services, right? At 194,000 and below, though, you'll be surprised, Jade, that the cost of living. They talked about, I think Sal in the welcoming ceremony talked about the cost of living and the affordability index out here. The rents in different counties, Santa Barbara, Ventura County, Los Angeles County, really high, that even somebody that's earning 120,000 with health insurance and paying the rent, it's really difficult for these folks to be able to pay their rent and still be able to save enough for a down payment for closing costs. It's hard. And we understand that. Part of our advocacy group, part of our advocacy work that we do with our executive director, Berta Garcia, is going to Sacramento, going to Washington and saying, we need more help. We need to change and tweak these guidelines because this is what the data tells you and this is what you need to consider. As a nonprofit organization, a CDFI, one of the only CDFIs that focuses on home ownership, CDFI standing for Community Development Financial Institution. It's a designation that's given to us by the U.S. Department of the Treasury. We're able to, at that point, really kind of push the envelope to work together with other nonprofit organizations around the country that do what we do to really apply pressure and try to make some changes that benefit the families that we're trying to assist, not only in Ventura County, but across the country.
Kelly said my point exactly.
Yeah.
She's making decent money, but the cost of living is so high, and you
Right.
know, as a single woman, it's tough.
Right.
So Laura asked, will the DPAs lessen chances of the buyer accepting my offer in this crazy market?
Well, the DPAs lessen the chances for the seller, probably the seller when they're making offers to accept their offer. You know, I got to tell you, unfortunately, that could become a challenge. The majority of the real estate industry doesn't really even understand that these programs exist. And that's the truth. You could have a real estate agent that's been in the business for 20 something years, have never heard of these types of programs. We're a nonprofit organization. The way we get our word out is to do what we're doing here, word of mouth. We don't have the high budgets for advertising and to put a billboard on the 101 or anywhere else. So it really is a word of mouth. It's as what we are doing here so that people are aware of these programs. And it is a challenge, no doubt. But when we look at somebody, when we approve someone, we have to be absolutely sure that they are eligible for the down payment assistance programs. So we do a full vetting. We're looking at all of their assets and income because we are dependent upon that down payment for them to be able to move forward. And at the same time, we're looking for the qualification. We're doing both simultaneously. So some of the buyers that are looking with the down payment assistance, they have been some of the best vetted buyers. And very few, once they're approved, will not be able to move forward because of it. So that is a challenge, and that's something that we need to work on to be able to educate the rest of the real estate community about these programs, to not be afraid of them. Sometimes, the idea is that it may take longer for some of these. I think right now the state program that the secretary talked about, there is a long delays in those programs because one reason, the amount of demand for them, which means the need is enormous. And not very many people are doing it. Not very many originators are doing these programs. So when you have very few and there is enormous need for this and there's money out there for people to buy, then you are seeing these bottlenecks right now. And the low interest rates, lowest interest rates in 30 years probably, you have a lot of people really kind of applying and trying to make this happen.
Great information. AC asks, you mentioned under Cal HFA, you mentioned that if you work for a school district, do you mean if you are a teacher or employed by a school district? Is that what you were referring to?
It was. So when you're looking, when under the Cal HFA program, if somebody is working through a K through 12 public school, it's not just a teacher, it's lunchrooms, janitorial, office administrators, anyone that's working in this public school system, and some charter school systems actually can get the full amount of the down payment assistance that they provide at Cal HFA. So I'll give you an example. Cal HFA made an important change to where they would provide up to 3.5% in down payment or 3% for down payment, which was the entire amount of the loan amount or the purchase price. They limited that to $10,000 only. So, however, if you're working in a K through 12, that $10,000 limit does not apply to you, and you're able to obtain the full amount. So for anyone that's out there that knows a teacher that, or not a teacher, I want to take that back. It used to be called the Teachers Program, but they changed the name because many in the school industry, in the schools, public school system, thought that you had to be a teacher to be able to take advantage of the program. The answer to that was no, it's anybody working in the school districts. So we changed that name. If you know anyone, this is a phenomenal program to be able to take advantage that would cover your down payment and a big portion, up to 3% of your closing costs, where you're coming in with very, very little money down. Now, that is up to, in Ventura County, we talked about the number today, $194,000 or less. But if you're at low income as well, what we've done at VCCDC is also incorporated our down payment assistance along with the state's programs to bundle everything together, bring affordability even more within reach for these first-time buyers.
Excellent information. Monique wanted to know, what is the income limit for two-person family in Santa Barbara County? And if we are over the limit, are there any moderate income programs?
There isn't. So Monique's asking a great question. So two-person household size in Santa Barbara County is $76,250. If you're under that amount, you're considered low income as a household size of two. If you're over that amount, then you're considered a moderate income. Okay. This is where that state program could also be a part of that transaction, where they can take advantage of that. Because in Santa Barbara County, the Cal HFA program is up to $173,000 or less. So if you're under that amount, so these are enormous amounts, right? These are big. Now the question also that we need to, and I need to make sure that we talk about, is also different jurisdictions, different municipalities also offer down payment assistance programs to first-time buyers that are, or not even non-first-time buyers that are looking to buy in certain areas, even certain cities. So she talked about Santa Barbara. Carpinteria has had some down payment assistance programs that we've been able to use with them. Goleta, Lompoc, and the city of Santa Barbara has like certain areas, and you know, the map kind of looks like a football, so it's pretty strange on who's eligible for that. But those are also programs for higher earners that you're able to take advantage of. In our booths, you can also visit the City of Oxnard. City of Oxnard has down payment assistance that over time, we've also combined with our down payment assistance to where we were providing up to $103,000 in down payment assistance to first-time home buyer families. $103,000. And this is huge. This is huge. So we have worked with municipalities all across the state, Los Angeles, Kern, we've just designed, so anybody that's listening to us in Kern County, with the city of Bakersfield, we have just worked with the city of Bakersfield to create a program, writing the guidelines as we speak, so that we can disseminate up to $250,000 of monies to first-time home buyers out in Kern County. We just did that with the county of Ventura as well, with the Hope to Home program that I discussed earlier. And those programs are running out fast, though. As we speak about them, everybody's coming in. They're realizing that these opportunities are golden and rare at some times. So, you know, it's looking at your different municipalities, calling in the housing authorities or the housing departments within those cities to find out if there's any monies available, and looking at us to possibly bring those monies and combine them for additional purchasing power.
Sure. So we continue to talk about the income, you know, the qualifications as far as income. Laura wants to know, is the income based on the last 2 years, or does the current year count as well? She said, because what if the current year income I made over the amount? In other words, life is getting good for Laura. So, she wants to know does this year count or just the last 2 years?
That is an excellent question. And congratulations to you, Laura, for doing a lot better. That's what life is all about. But she's right, because that's an excellent question. What we look at for eligibility is from this moment to the future. We project out 12 months on whatever they are doing. The historical is more of a calculation that we look at the qualification. We want to make sure that what Laura earns, for example, overtime, there could have been a whole lot of overtime in the past, but it's not happening anymore. We don't want to put them in a situation where we're depending on something that isn't dependable for them to make their mortgage payments. It's just not something that we want to do. So we want to be really conservative and look at the historical to kind of get an average over what we can and cannot use. But for eligibility of down payment assistance programs, it's everything to the future. It's the kitchen sink is thrown into that and it's projected out. So it really is this balancing act of being able to look at two different methodologies of calculating income for eligibility of down payment assistance programs and for qualification of mortgage products and first mortgage loans.
Okay. Omar Espinoza asks, is a DACA recipient, someone who works in education, who has a social security number and not a TIN number, eligible for down payment assistance?
So DACA participants, yes. This is when we talk about the excitement of the mortgage industry and the changes. When I said I thought this would be pretty boring, there is always something new. We were very well aware of what happened to DACA recipients a few years back, a year and so back, and on a federal level. Because in fact, we had a DACA participant that was working with the local, in our partnership with the local Habitat for Humanity organization. And so we're very well aware of the Supreme Court's decision just recently again on DACA. So as these guidelines start to flush through the mortgage industry, through the guidelines that allow DACA to move back, yes, the question to that is there are programs for DACA participants. We would just need to make sure what's been, whether it's an FHA, Federal Housing Administration loan, a conventional loan through Fannie or Freddie, or we're looking at Cal HFA, and has that already reached the guidelines for underwriting so that we can continue to move forward for DACA participants.
Okay.
Yeah.
This question is from Albert. Hold on, because Albert asks really long questions, and I love Albert because he is very detailed oriented. Albert,
okay.
Yeah, thank you. And he always puts at the end, sorry again for the long question.
All right.
Albert says, what is a realistic or average mortgage with DPA? Of course, he understands that there's factors like price, down payment, seeing the low rates and thought process of what if we can find something that's in the mortgage range of what we pay in rent? Does that make sense?
I think so. You broke out a little bit, Jade, on the first part of that question. Can you read it out to me again?
Oh, I'm sorry. What's a realistic average mortgage with DPA?
A realistic average mortgage with DPA. So that's a tough one to answer, but I think a realistic average mortgage with DPA, it really is going to come down to how much DPA is available. So give you an example. I just mentioned $103,000 with the city of Oxnard. If Albert is only able to afford a $400,000 mortgage, that's what his income could sustain right now. If he's able to get a $400,000 loan amount, Albert might find that there isn't any $400,000 homes in the area. So if we can assist with $103,000, then technically Albert would be able to afford a $500,000 because with a $100,000 down, Albert's now financing that $400,000 loan amount. So his payment would still be able to make a $400,000, but he's buying a $500,000 home. And that $500,000 home now may provide better options to whatever school district he's looking to purchase in, whatever city he's looking to purchase in, is really giving families and individuals or people like Albert an extra couple steps in that ladder to be able to reach the lowest hanging fruits of the areas that they want to buy. So the down payment assistance is crucial, obviously. The low interest rates, phenomenal. And it's a combination of all of those things that bring purchasing power just a little bit more closer within reach for folks like Albert and anybody else.
Sure.
I hope that answered that question. Did I miss anything else? You talked about rates, down payment. Yeah, I think that was everything, right?
Yeah, I think that was it. Albert, if there was something else that we didn't get to, Albert, please just put it in the chat. No, he said, I appreciate you guys so much. We appreciate you for tuning in, Albert. And we're
thank you, Albert.
You owning your new home. If we have over $10,000 saved for a down payment, does that automatically disqualify us from these programs?
Not at all. Not at all. Look, we've had people that have put in hundreds of thousands that they've saved. I'll give you a story, and this is obviously a true story. Mm-hmm. We had a family, gentleman worked on a ranch. He lived on a mobile home in a ranch and was a ranch hand. Had 5 girls, one of them accepted to an Ivy League school. He was minimum wage, but he was able to save over $100,000. Now, one of the questions was that, he was eligible as a low-income family of 7, 5 girls, husband and wife. And he really didn't want to put in the entire amount of down payment of money that he saved into the transaction. Some programs do require that anything over $5,000 has to be a part of that purchase first before the down payment assistance goes in. We were very intentional in saying that we can't penalize someone that has worked their lives to save those monies, right? So if they can only put in a certain amount or they only need a certain amount, they can keep the remaining amount for a rainy day, for emergency funds, for college, and all of the other things that life is going to bring at people. But there is a formula. There's a formula that if you're keeping a certain amount of money, when we're looking at down payment calculations or what your area median income is, whatever you're keeping in assets, we take a percentage of that. If that percentage plus your income, you're still under low income, phenomenal, not a problem. We've also looked at, well, listen, if you have 70,000, you're going to be over. But if you have 65,000, you're still good. So we have them put that extra $5,000 into the equation because it makes sense. There's a strategy as to why do that, of course. But no, it wouldn't disqualify you whatsoever. In fact, it would help you because then you'd have our down payment if you're eligible for that, plus your down payment to be able to do something and make more of an impact.
Awesome. Robert asks, if a 2-person household has combined $70,000 in Ventura County, how much home price can they qualify for? Wow.
I knew I should have brought my my handy dandy calculator for this. I would recommend.
Second, Alex, you have to show us that calculator again because that is not even like you're not even using your cell phone. That I haven't seen a calculator like that in a long time. So that.
Oh my gosh, since college. Awesome. I can't use the regular ones anymore. That's a very specific question. I would recommend that they actually go to our booth and we can help them out directly on, what $70,000, what that would look like. Because the $70,000 a year, household size of 2, eligible for down payment assistance potentially because they would be considered under that household size of 2 in Ventura County of $72,300. So to be more specific on those amounts, please follow the booth. We've got some of our VCCDC staff and LOs ready to assist there.
Here you go, Robert. Start your process right now. Great question. Carl asked, I'm a single parent, household of 2. Based on my hourly wage, my annual income is a little over $73,000. I have $5,000 in savings so far. Do I qualify for any DPA? City of Ventura.
City of Ventura. Give me that number again, por favor, Jade.
73,257 is the annual income.
He has how many kiddos?
It says I'm a single parent household of 2. So it sounds like if the household is of 2, maybe just one child.
Okay. So household size of 2, it could be that they're right over. Because again, that household size of 2 in Ventura County is the $72,300. However, there is the program through the state because he is under $194,000, then we can look at those options as well. So yes, down payment assistance would still potentially be available for him.
There you go, Carl. That was a really great question. Really great
Yeah, thank you, Carl.
Are there any, no, let me go with this one because I really like this one. Kind of switching gears, and again, please continue to submit your questions in the chat. How do you seek out a trustworthy real estate agent?
I saw that question. That question's been on there, and my gosh, that is a good question. That's an excellent question. And it's not only just real estate agents, but loan officers, everybody. Look, people are still worried. People still remember what happened in the Great Recession, 2007, 2008, the foreclosures that occurred. So you do want to be able to have a trustworthy agent, a trustworthy loan officer, a trustworthy everything. You want to do your due diligence for sure. I think that if you're thinking about down payment assistance and anybody discourages you from that, that's just not trustworthy. You've got to be able to look at all of your options, of course. If you are, you've got to interview different people, you know, you've got to interview different agents, compare them, see where they're at, look at what you know, ask for references, of course. But that is a very, very difficult question. I don't know how to answer that. I think that you know, many people have great just self-judgment of what somebody just doesn't seem right. You know, you can go out and ask questions to somebody else to see where we're at. You know, attend our HUD certified first-time homebuyer workshop that gets you the HUD certificate that goes through A through Z about everything within the lending process, everything within the homeownership process, credit, how to select an agent, inspections, inspectors, all of that is there. So so I don't know. But just be vigilant, obviously, you know.
Sure. And
Yeah,
it's so subjective too. Yeah, no,
it is.
that is a tough one. Anna wants to know, she says she has $17,000 for down payment plus an IRA. Do you recommend using these funds to increase her down payment?
I think it would depend, but yes. If somebody needs a certain amount, if homeownership is that goal, you do have access. You know, every program, every IRA, 403B plan, 401k plan, they all have a component built in within them. And you want to talk to your program administrator on these programs as to what do you have access for purchasing your first home. Usually, rule of thumb is about 50% of those funds that you're able to buy as a first-time home buyer. And you basically take it out as a loan and you pay it back to yourself. Now, it's really important. I would suggest that you talk to somebody that is like a financial planner or a CPA, that you don't remove those monies out early, that you do it through the part of the process that you're already in escrow, that you've already in a contract, that those monies can be sent directly to the escrow company and not to your own personal bank account, because it could be treated as a rollover where you have to pay a 10% penalty and then have to file them as income at the end of the year. So there are some variations legally in that. Again, don't take my advice on this. Contact a CPA for that. But you are absolutely able to use those funds. And for many families, that's what allows them to buy. I had a lot of questions asked. If I don't have down payment assist, if I'm not eligible for down payment, if I don't have any money saved, you know, many people forget that they do have this money saved in their IRAs and their 401ks. And so, you know, that is a component to be able to, or an option to be able to come into home ownership or have the monies required to do that.
Patty would like to know, can you talk a little bit more about HUD programs?
HUD program. So HUD program stands for Housing and Urban Development. It's part of the cabinet of the federal government. And through that is the FHA, the Federal Housing Administration. So the Federal Housing Administration and HUD, different types of HUD programs, I'll talk specifically just about the FHA. So the FHA has been around since the 1930s. It was developed to really kind of stimulate home ownership, to provide for the first time a 30-year fixed mortgage that would allow Americans at the time after the Great Depression to purchase a home for 30 years at a very, very low down payment. Today, 3.5% down is all that's needed with the FHA. So those programs are just what has allowed a lot of people to buy. I'll give you another example. After the Great Recession of the foreclosure crisis that happened in 2008, 2009, 2010, there was no one issuing mortgages at the time. Private money had just left the marketplace. And the only ones doing loans or guaranteeing them, because the government doesn't do any loans, but they guarantee them, was the FHA product. And it came to a time where FHA was too invested in doing too many of the loans in the country, and they wanted to basically step back a little bit so that private money could come back in. And they did that by doing certain changes within the FHA program that one still is today, where if you're not putting 10% down in FHA, the mortgage insurance premium stays on for the life of the loan, where before it would go away when you reached a certain percentage of equity after the normal payments that you were making in your house. So those kinds of changes try to make FHA a little bit less attractive so that more money can come in, private, FHA, Fannie Mae, Freddie Mac, conventional products. And so, but still today, if it's the only program that someone's available or able to purchase, by all means, it's a phenomenal program because it's the one that allows you to get into homeownership.
Alex, do you need a drink of water yet? Because we have tons more questions coming. Yeah, go ahead and sip your water. If you guys are like enjoying this information just as much as I am, feel free to also put that in the chat, but we definitely have more questions for you. Look, I was trying to give you a little bit of a breath because, man, you are those answers. I love it. This one comes from Amy, and Amy says, are properties in communities that are 55 plus, are they eligible for these programs?
They are, absolutely. Yeah. So as long as you're buying your home, first-time home buyer, if the program requires first-time home buyer status, you can be a repeat buyer as long as you haven't owned a home or you don't own a home at the time. So all programs are different, but if you're buying in a 55 and over and you're 55 and over, then yes. You know, there are some differences where some of these programs, what they don't allow is when you're buying a mobile home or a manufactured home that is not placed on a permanent foundation and the land is not included in the sale, then that's a different, the property is a different status at that point. But the buyer themselves, and if the property is a single family or a condo or a PUD, not a problem. You're still eligible for those types of units.
Okay, Lorraine's question actually came up a little earlier when we were speaking of IRAs. Can IRAs count in a secured loan?
Can IRAs count in a secured loan?
Yes.
So IRA, IRA, the IRA independent retirement account or individual retirement account, usually it turns into an IRA when you're working for an employer, you're no longer there, they transfer that and it's called an IRA. You put it somewhere else, right? Don't take my word for that. I don't know. But that's what it is. Don't quote me. Don't make decisions off the information that I'm providing you. Seek your CPA for that. But an IRA, is it considered a secured account? Meaning that an IRA would still be, I'm not sure if I'm understanding the question, but an IRA, if you're pulling those funds out, because it's not through an employer anymore, if you pull monies out, you may only have 3 months to have to pay it back. You might see a penalty on something like that, as opposed to your employer active 403B plan, 401k, that you borrow against that. And through your pay stubs, you're paying it back because it's being managed or administered by your employer, by that group fund. So an IRA, if you're no longer under that, it could have different rules. So just, again, seek some financial advice on that through most likely a CPA.
Okay, great. This is a really good question from Latasha. And it says, when you are determining your household income and number, do you include adult children?
That's an excellent question.
That is.
That's an excellent question. And the answer to that is yes.
Oh.
Yes. So you include adult children. And here is also the caveat to that, is that you also include the adult's children's income as part of that household size. Yes. Yeah, so even though they're not going to be using their income to the purchase of the home, it may only be the folks that are buying. Let's just say in this case, it's the two parents or whatever combination that is. But the adult children that are part of that, we do include that income as part of these numbers of where your household limit is. Now, the other thing that I would say, if there's kids that are full-time students and they have a small part-time job, there are certain rules where we're not using all of it because they're considered for full-time buyers. And this is a rule through HUD where we can use only up to $480 of that amount. And so it still kind of protects and brings down that maximum household income to ensure that they're still eligible for the programs, hopefully. But that's a great question. I'm glad that they asked it.
That is a great question. This is similar, and this is another great question. It says, I have a household of two. One is a senior citizen collecting Social Security. Do the Social Security benefits count towards exceeding the household low income limit? So an example, one person makes 70K, senior citizen makes 20K from Social Security. Does that count as 90K for the income?
It does.
Oh man.
It does. Yeah. That's why it's so important. When we work, and this is going back to why someone is so vetted, Jade, when we go through this process with people, these are the questions that we're asking. So when we're looking at income of folks that are not a part of the household or not a part of the purchase, but to ensure that they're still eligible, we're asking questions. Do you have any adult children or any children over the age of 18? Are they employed? You know, parents that are earning Social Security or a pension or anything. And we take all that in and we are looking at it all. So it's a 2.5 hour session that we're doing because we want to be absolutely sure that the monies that we're going to provide is eligible monies so that when they buy a home and we're including it as part of their purchase price, that they're also qualified for a mortgage because we're depending on this. And hence, you know, one of the pull-through rates that we have is a very high, meaning that whatever we approve, they close. You know, there might be some delays here and there, like everything right now in this industry, but we are doing a full vet and a full vetting process, a full verification process of this. And this is really to protect them. They're going to spend a lot of time going out looking for homes. You know, it is a stressful situation right now with COVID and people buying and multiple offers. And, you know, Karen mentioned how she was getting outbid by cash offers. She thought, that's it, I'm stepping away. There is a lot of emotional equity that's being spent when you do this. So we need to be sure that when you're spending all that time, that we're pretty darn confident that very little things were going to go wrong, where you're not going to be able to get an approval in the 11th hour after you're already in escrow.
That was a great statement. Emotional equity. OMG. Like, all right, gotcha. I think I know the answer to this question, but I want to ask it anyways. Can two family members, maybe a brother or a sister, maybe there's two cousins, can they buy a home together but qualify individually for down payment assistance to maximize the amount towards the down payment?
Okay. I'm going to have you see if you were thinking the same way on your answer, Jade. But the question is, so the answer to that is yes, two siblings can purchase together. However, it's a one household size. It's everybody in the household. So the down payment assistance is going to the household, not to individuals. So no, we wouldn't be able to give them the down payment assistance individually. We're looking at everybody in that household that's purchasing.
That is tough. I mean, it's great, but it's just a tough philosophy to kind of, especially like when the young man earlier was talking about the Social Security being added on. You have adult children living with you. I would hate to say put your adult kids out for like the next year and then have them come back later on. Whew, okay, but this is really, really great information. We have so many coming in. Thank you so much. And you guys, please hurry up and get your questions in because time is definitely dwindling down. Let's see here. I'm going to pull one of my questions off of my sheet. This was an amazing question. How are the closing costs calculated?
Closing costs are calculated. They're published in detail in what's called the loan estimate. So how are they calculated? It's usually a percentage of the sales price, a percentage of the loan amount as well. Okay. So origination would be a percentage of the loan amount. So the lower the loan amount, the lower the origination. And that's a good example. We talked about, I think it was, I'm not sure if it was Albert talking about when we said the 400,000, 500,000, how much can we buy? When they said ratios, down payment, and rates. So if we knew that Albert on a $500,000 purchase, when we're providing $100,000 down and the first mortgage is only $400,000, then the origination, the fees are usually off of that $400,000 and not off the $5. So we've reduced those fees by that amount. The other calculations, the other things that go into the closing costs are title, escrow, appraisal, notary fees, and all of those are added. We get that from the actual notary or the actual escrow company and title company that are doing that are represented in the transaction that they're in. There's prepaid items like property taxes that need to be included in the payments, right? So a lot of the down payment assistance programs require that their fire insurance or hazard insurance and their property taxes be included in their payment so that they're actually being paid to the county and to their insurance agent twice a year for the taxes, once a year for the insurance agent, directly from the servicer, and the buyer doesn't have to worry about making those payments or saving it aside separate from their mortgage payment. So that's already, you need to have an impound account that is money that you're paying to yourself and paid into these two prepaid items like taxes and insurance, or flood insurance if you needed flood. And that's a part of the closing cost. Now there's two: recurring closing cost and non-recurring closing cost. The recurring closing costs are things that are going to continue no matter what. Property taxes, insurance, interest, those are recurring. Non-recurring closing costs mean it only happens once because of the transaction. Title and escrow will only happen one time on your purchase. Processing, origination, any of those fees, and just in general in the mortgage industry standard, are just one time, and those are what's called a non-recurring closing cost. Certain down payment assistance programs are used to pay some of those closing costs. Some of them can pay all of them. Some of them can only pay the non-recurring, because the recurring, they don't pay your property taxes and your insurance agent, you would have those, right? But the down payment assistance do cover closing costs as well.
Jesus just wants to say thank you for this helpful information. I agree, Jesus, this has been amazing. Lucia would like to know, can you tell me about credit points towards your interest rate?
So buying the interest rate down, right? I think so, yeah. That is an option for a lot of programs. You can buy the interest rate down, and it would depend. You have to do the calculation of whether it makes sense to do that or not. Because I think some of the questions that we need to ask and understand is, how long do we plan to be in this home for? Is this the forever home? And I'll give you an example why. So if somebody is putting $5,000 to bring down the interest rate by a full percentage point, I'm making this stuff up in my mind here, just hypothetical. So if you're paying $5,000 and that's going to save you maybe $150 a month in mortgage payments. So the $5,000 that you invested, I'm doing the math here, at $150 savings, it'll take you about 33 months to recover that $5,000 that you invested today that you'll get over the long run as a result of a savings monthly on that amount. 33 months is not bad, but I'm kind of exaggerating what that savings is per month, of course. If it's going to take you 9 years to recover that, and you think that you're not going to be there 9 years, then it doesn't make sense to invest $5,000 today in the hopes that you're going to get it in the future, because you invested today. After that 9 years, it's all savings from there. You reach your break-even point. So that's one of the reasons. The other one is that somebody may not be eligible based on debt-to-income ratios, and they need a lower interest rate. Right. So maybe putting an extra $5,000 down to down payment isn't going to change your payment very much, but if you put $5,000 to the interest rate, you could have a bigger impact on the lower payment that allows you now to qualify because your income to your debt is now within the guidelines of that program. So it's a strategy, but you really have to be able to do a cost analysis of, does it make sense? And this is where we talk about trust, where whoever you're working with, LOs, have to be able to make that analysis, to pull out that calculator and do it and explain it in a way where people are understanding that, right?
Is there a kind of a rule of thumb that if it's going to take you more than 5 years, let's say, to break even, and it's probably not a great decision? Or is that, I don't know where I got that number from. I feel like I heard it somewhere today. I don't know.
I don't know. No, I don't know if I've heard that myself. I think it comes down, if it takes more than 5 years. Here's the thing: if you're going to stay there 30 years, then you can see that in 5 years you were, you invested today to break even in 5. Then the next 25 years your savings are X. So if I said $150 per month, right? So 25 years left, that's 300 months, $150, that's $45,000 in savings over the life of that loan. Now you're looking at, okay, yeah, I'm gonna invest $5,000 today because I'll ultimately be able to save $45,000 after that time that I break even and recover that. But the question is, are you going to stay there that amount of time, of course?
Sure. A recent college graduate is now making $70,000. How long do they have to be employed to be able to apply for a loan?
That's a great question. I think I had another one in the conversation log a little bit similar to that. So usually the rule of thumb is 2 years, right? 2 years of employment. It's not an exact science, but usually the rule of thumb is 2 years. If you've gone to college, you've received your bachelor's degree, and you're employed immediately in something that's in related to your education, then your education counts as your time, your employment history. So your 2-year bachelor's degree plus your job, you've got a contract, you should be fine. You could take the $70,000 new contract. Congratulations on finding a job right after college. Right now, it seems like a lot of people have struggled with a lot of that, but that can be used, and you could be on your way to getting approved.
Interesting. Wow. That's great information. So Lorraine and Brenda both want to just thank you. Thank you, Alex, for the great information.
Thank you, Lorraine. Thank you, Brenda.
Latasha says, where can we find a household income cheat sheet to determine if we are low income, medium income, or high income?
Cheat sheet. I think that if they email us to ask for one, we can give them that cheat sheet, but it is published in the HUD. If you Google HUD income limits Ventura County, HUD income limits LA County, whatever county you're in, if you Google those, that information is published there. Different programs go off the federal government, like what HUD is, and some go through the state program, like HCD, the Housing Community Development. And so the good thing is that this year they both match, so it's the same numbers. That hasn't always been the case.
Right. So we have a few more minutes left with Alex. If you have a few more questions that you'd like to ask, please go ahead and submit those now. Is there any down payment assistance programs that need to be paid back at the end of the loan?
Phenomenal question, and I haven't talked about that. Okay, that's great. There are different types of down payment assistance. I think we probably could have started there. There really is different types of down payment assistance programs. Some of them are deferred, meaning they don't get forgiven. They're deferred for 30 years, and they could carry a simple interest rate of 3%. No payment requirements on this. It could be deferred for 30. If you can pay it, and if you want to make some payments, phenomenal. The idea with these programs, Jade, is, for example, a 30-year deferred loan at a 3% simple interest rate. Some of them are as low as 2%, like through the state, 2% simple interest rate. If you've got a 401k at work, and by having this $30,000, it allows you to save an extra $120 on your mortgage payment. So you don't have to make that because you have it through this down payment. If you can put that to $126,000 into your 401k and your employer is matching it, and it's actually accruing interest on a compound basis, then that money should be growing a lot faster than this simple interest at 3%. That's the idea. So it's a way to build wealth. So some of these programs which are deferred have to be paid back. But there are other programs that are forgiven. There really is money out there that we say, I don't want to use the word free money because you have to adhere to certain requirements. But we've worked for many years with the Federal Home Loan Bank of San Francisco. In fact, we're on their website. Our organization, one of our families, it's also another success story, is on their website as well. About her story is told there. And this is a forgivable loan. For every dollar that an eligible low-income family comes in with, it's matched by $4. So if they're coming in with $5,500, we can match it by $22,000. And again, this is forgivable money. It's actually forgiven every year they stay in that home. 20% of the amount that they receive is forgiven. So if they get the entire $22,000, Jade, $4,400 is forgiven. It stays as equity in their house. Non-taxable. They're not taxing for this. It's actually income that stays there, unless when they sell it in the future, capital gains would have to be an issue, right? But this is forgiven money until after year 5, the entire $22,000 is forgiven and it stays with them. The other program that we've talked about that we released in June is the Hope to Home with the County of Ventura. And that one right now, with the amount of attention, so many people that are out there shopping with these loans and escrow now with these programs. Also $23,000 forgiven after 5 years. Now, it's not like the WISH program where it's forgiven every year. It's just you have to stay there for the 5 years and it's forgiven. That's $45,000. So we have families out there today that in 5 years, they've got $45,000 forgiven. They're going to be $45,000 richer. That, again, is a way that we empower folks to build wealth through home ownership because of programs like this. And the ones that are not forgiven, where we're looking at a plan to how do you use that money, the opportunity cost of not having to pay it, to be able to get it to grow more quickly on other areas like retirement plans and things like that.
Okay. I think we have time for maybe one more question. So many people in the chat are just saying, thank you for the information. I definitely would agree. It says, who should I reach out to ask about stacking SB workforce housing programs with the awesome VCCDC DPAs?
SB, is that for Santa Barbara?
Yes, Santa Barbara, yes.
Okay, so so stacking programs with, so if you've already been approved, if they've been approved through the Santa Barbara program, whichever one it could be. Sometimes there's some programs through the Santa Barbara Housing Trust out there. So we've worked with them and we've used those monies as well. So if you're already approved, then you'd want to apply also for down payment assistance that I just mentioned, or the layer, depending on where you are as far as a household size. And then we stack them together. So it's probably reaching out, reach out to the booth, our virtual booth that we have at VCCDC, and would be happy to provide more information on how that could actually happen.
Okay. I'm going to put you on the spot really fast.
All right.
Is there a question, Alex, that you wish people ask? Like, is there some information, and this will be our last question, just for now, you guys, we still have our closing ceremony and a bunch of great information coming up in about 10 minutes.
Mm-hmm.
As we're going to be giving away those prizes we talked about earlier. But is there a question that you think people just need, and they really need this information when it comes to talking about the down payment assistance or just home buying in general?
You did put me on the spot, Jade. I think one of the things that I would definitely say is to ask the question, to contact. There's a lot of different types of down payment assistance programs. I think what we get the question is it too good to be true?
Ooh, that's great.
And the answer to that is no, we're doing it. But as you're out there shopping and as you talk to people, and people in the industry sometimes, unfortunately, may say, doesn't work, can't do it. Mm-hmm. You've got to find out. You've got to be able to ask that question to say, when you have it, that you can respond to that and say, no, it is happening. We have success stories. We have plenty of success stories, and we will continue to work on that. I think as we run out of monies, Jade, different types of programs that we receive during different parts of the year that we stack, it becomes that, know about the programs. How do I continue to stay engaged and know what programs are out there? Really research this information. We have, and I'll share this, through the state of California, VCCDC was awarded an additional $3.3 million for down payment assistance that's going to be going to moderate and low income families, up to $100,000 in just this program alone, Jade.
Wow.
So if we have $100,000 in the other ones, the other 45 comes in to play, then you're looking at 145,000 is a real possibility. So they're there. We utilize them, we get more, we utilize them, we go out and we advocate for additional monies. And Berta will most likely be contacting Lourdes again to see what is it that we can do to facilitate a lot of the programs as an organization and as the state government to make this happen for nonprofit organizations that focus specifically on this. So that's a long-winded answer to say, the question is it too good to be true? And the answer to that is no. I think you want to continue to ask that, or if somebody asks you that, and that you say, no, we've heard it. We've got it. We've got Jade's number, and we'll call her if it's not true.
Alex, I don't know who you guys are calling, but I'm definitely calling Alex, okay? Alex, I just have to thank you I thank God for 2002 when you switched careers, because again, along with everybody that's spoken today and including yourself, when you have a passion for what you do, you are sharing not only a wealth of information, but you are literally changing lives. You can tell by the information that you're giving. It's almost like talking to a family member, because family members look out for each other. And I appreciate you just having that passion for this. And I don't even think you probably do understand, but I don't think you understand the information that you gave today. I mean, just watching these comments and everybody's saying, thank you, thank you, thank you. I can't thank you enough. And it really, really, truly means a lot. So VCC, when they go to VCCDC, they link up with the program. Will they at some point possibly come across you, be able to contact you through VCCDC?
Absolutely. I'm here, and I appreciate your words. Thank you so much for that. But we are here. I've been here since 2007. Love what I do. Definitely passionate about the work, and plan on being passionate to this work for a long time.
And to think you thought that this was going to be.
I know. I know.
Alex, you're amazing. Thank you so much. We appreciate you joining us today and for all the information that you gave. Definitely life-changing. And there's going to be so many people that are excited now about the possibilities of owning their own home just from the information that you gave. So thank you, thank you, thank you.
Thank you, Jade. Thank you, everyone.
All right, you guys, don't forget, coming up in about 10 minutes, we're going to have our closing ceremony, and this is where we're going to give away raffles. We do have some more very important information to share with you there as well. So again, run to the restroom like really, really, really quick, grab you something to drink, and then head back to your computer, check your email, and click on that Zoom link. We'll see you in about 10 minutes, okay? All right, thanks. Bye.